Forward and futures contracts are agreements that allow traders, investors, and commodity producers to speculate on the future price of an asset. These contracts function as a two-party commitment that enables trading on a specific date at a price agreed upon when the contract is created. However, unlike forward contracts, the futures contracts are standardized as legal agreements and are traded on specific venues, such as a futures contracts exchange, which means the contracts are subject to a particular set of rules that may include, for instance, the daily interest rates and the size of the contracts. Although primitive forms of future markets were created in Europe during the 17th century, the Dojima Rice Exchange is regarded as the first futures exchange to be established. In early 18th century Japan, most payments were made in rice, so futures contracts started to be used as a way to hedge against the risks associated with the fluctuating prices of rice. With the emergence of electronic trading systems, futures contracts became very popular and are now serving various use cases within the financial industry. For example, a farmer can mitigate risks by selling futures contracts for their products at a certain price in the future. This would allow them to lock part of their income, regardless of market fluctuations or unfavorable events. Futures contracts also allow investors to take a short exposure to an asset, meaning they are able to enter a selling position without really owning the corresponding asset. Futures contracts can be traded multiple times until they are finally expired and settled. The expiration date is the last day of trading activities for that particular contract, and, after that, all involved parties are legally obligated to settle their positions. Settlement can be either physical or in cash. In a physical settlement, the party that sold has the obligation to deliver the underlying asset to the party that bought it. In a cash settlement, the asset is not exchanged directly. Instead, contract holders pay or receive, in cash, the amount that reflects their positions. Besides waiting for the settlement date, futures contracts holders may also choose to offset or roll over their positions. Offsetting refers to the act of closing a futures contract position by creating an opposite position of the same asset. This strategy allows traders to realize their profits or losses prior to the settlement date. Rollover occurs when a trader opens a new futures contract position after offsetting their initial one. This allows them to extend their positions before the settlement date, essentially moving from one contract to another. As a standardized type of forward contract, futures contracts are among the most used tools within the financial industry. To learn more about financial markets and cryptocurrencies, don't forget to watch our other videos at Binance Academy.